everybody. My name is Paul Sion with HER Realtors, licensed realtor in the state of Ohio and Kentucky. Welcome to my October podcast. With me today is Pam Paulson of Home Loans Assist. How are you doing today, Pam?
I'm great. How are you, Paul?
Great. Great to have you on.
Thank you for having me.
Sure. Why don't we get started, and why don't you give us an overview of who you are and what you do and how long have you been doing it?
Okay. My name is Pamela Paulson, and I'm with Home Loans Assist. Our corporate office is based out of Denver, Colorado, but I'm the territory rep for all of Ohio and northern Kentucky. We're in the credit restoration business, and I'm not sure if you're aware of this, but the FTC studies indicate that over 80% of credit reports have some sort of detrimental error on them that damage a person's credit score. So we are in the business. We've been in the business for over 15 years. And I hope to give you some insightful information on how credit works and where the scores are derived from.
Okay, great. Credit is actually a very important key when you're buying real estate, especially when you're borrowing money. So everybody needs to, should know about credit and especially knowing how to fix credit issues. Like you mentioned, there's a lot of errors.
Absolutely. One thing that our company, and I get asked a lot from mortgage professionals and realtors, is when they're looking at a credit report, they think what these errors that they're seeing is identity theft. And actually, identity theft is very rare. Identity theft is the malicious act of somebody stealing somebody else's identity for financial gain. What we do see is not actual identity theft, but it's identity fraud. And identity fraud can happen at two levels, at the credit bureau level and the creditor level. And I don't know if you're aware of this, but at the credit bureau level, they have a written policy that states if the first four letters of a person's first name match and 7 of the 9 social security numbers match in sequential order, those two individuals can be merged onto the same credit report.
Okay. I've actually seen that on my own credit report. I had somebody showing me as owning property in North Texas, and I've never been to North Texas before.
And were you able to get that?
Yes, fixed? Yeah. Actually, filed a report with one of the agencies, and they did the research, and they took it off eventually.
Okay. And then at the creditor level, oftentimes the less information a creditor has, it can be put on multiple people's credit reports. And so they're thinking, in theory, the more people that we can attach this to, they're going to get their payment and probably paid more than once.
Okay, and now they're hoping to get better coverage and more accuracy, by just throwing a wide net, which isn't always the case.
Absolutely.
So what can you tell me about the factors that make up the credit score? I know there's different effects on the credit score, late payments and how you pay and what kind of debts do you have. Can you talk about that a little bit?
Absolutely. So we'll start kind of at the beginning, the basics. So FICO, specific to the mortgage industry, is the Fair Isaac Corporation. It's a group of mathematicians and statisticians who create mathematical formulas which measures consumers' credit risk. So basically what you're asking is a two-part answer.
Okay.
So the credit score for the mortgage industry has to do with the algorithms. So there are 56 algorithms created over the many years. 8 have been approved by Freddie and Fannie. 3 are used on the tri-merge credit report.
Okay.
And then the second part of that answer, it has to do with contracts. So there are negative and positive contracts. So talking about late payments and how that can be detrimental. Let's take, for example, your cell phone. If you don't pay your cell phone bill after 30 days or 60 days, they will most likely shut off your phone. That's the incentive for the consumer to pay that bill, and they'll turn it back on. It does not report on positively or negatively on your credit rating. However, positive contracts report all positive payments and negative payments, and they associate it with a high dollar risk, like your mortgage payment, car loan. So if you don't make your payment on time, that is going to negatively impact your credit score.
Okay. So with things like mortgage payments, are anything weighted more? So is a late utility payment weighted less versus a late mortgage payment or credit card payment?
No, it is not.
So they're all equal?
They are. And I don't know if you've ever seen that the pie chart. It's all the algorithms merged together and then divided into 5 pieces, which make up a credit score. 35% of a person's credit score has to do with payment history.
Okay.
That's where all the positive and negative payments live. So you make a payment on time to your mortgage or your car loan, and it's like a check, thank you, you paid on time, that's helping your credit score. And then on the reverse side, one late payment can negatively impact a person's score 60, 80 points. And to get those late payments off the credit report, especially if it's reporting consistently as a late payment, does detrimental damage to the credit score.
Okay, so the pie chart is basically the breakdown of what components equal to your total credit score.
Correct. And one thing that most people don't realize is 30% of their credit score has to do with revolving accounts. And so when we work and coach with our clients on paying down those credit card balances, we like to see what type of money they have today, tomorrow, next week. We assess all of the balance, and then we work helping them pay down those credit cards.
So in talking about credit cards, I know there's a credit utilization, like how much you're using of your total credit limit. How does that impact a person's credit score?
So if ideally a consumer does not want to put any more than 30% of whatever that credit limit is.
Okay.
The sweet spot, where you're really going to get major points is keeping your credit card no more than 10%.
Okay.
So if you have a credit card that has a limit of $100, you really don't want to put any more than $10 on that card.
Okay.
And then pay it off when you receive the bill in the mail. You can pay it off to a zero balance. However, you're going to want to put another $10 or no more than $30 on that credit card at any given time. You have to use the credit card in order to gain that positive payment history. A lot of our clients either don't have any type of credit card and they're not gaining positive payment history. That 35% is actually helping their credit score.
Talked about people who don't have credit cards and somebody who wants to build up their credit history because they're getting ready to buy a house. So I know there's a thing called secured credit cards. What can you tell me about that? How does somebody get one of those, and how does that help them?
So with our clients who do not have any type of credit card or revolving accounts, we'll have them go to a website called openskycc.com. And we like this site because it's 100% approval rate, and they don't do a hard pull. So it's not going to hurt them if they were to go to, let's say, a bank and try to open up a secured credit card. The banks will do a hard pull, and it hurts the credit score. So openskycc.com, what the client will do is put maybe $200 into this account. So they are sending in a check, a money order, to openskycc.com after they apply online. And then in about 2 weeks, the credit card is sent to them. And by using this credit card, like I mentioned earlier, around 10%, no more than 30%, putting balance on there, paying it off, by the third or fourth month, we've seen credit scores jump anywhere from 80 to 100 points.
No, that's pretty beneficial. And you had mentioned in talking about that hard pull, and I know there's a soft pull. I'm familiar with those terms. Why don't you tell us what those terms mean in the credit industry?
When they're in the market to purchase a home, they will go to their mortgage professional, and that's where they will have their credit pulled, which is considered a hard pull, and it does lower the credit score. When we assess or look at an individual's credit report, we use either identityguard.com or privacyguard.com. It's the closest to the FICO algorithms specific to the mortgage industry. And even though it's an online credit score, it is inflated slightly, maybe by 10 or 15 points, because they're not using the same algorithms as the tri-merge credit reports.
Okay.
But at least it will not hurt the individual's credit by doing a soft pull.
Okay. So the soft pull is basically just a different type of look at the credit.
Correct.
Okay.
And unfortunately, a lot of our clients will come to us with these online credit scores, and what they don't realize is, again, those online credit scores are inflated by 50, 60, 80 points. And so once we do the soft pull, we get a better idea of where their credit score really is and where we can start helping them.
Okay. Let's talk about a little bit about, somebody going through a divorce, and how does that affect credit rating? I mean, do you see any effects? I know debts of the spouses can affect each other.
Absolutely. And unfortunately, in this situation, if the spouse is on, let's say, an auto loan, and they stop paying for whatever reason, whatever the court orders, it doesn't matter.
Okay.
So that little piece of paper that's signed by the judge, unfortunately, you still have to make the payments. So in a case like that, sometimes it's better to try to get the spouse's name off of the mortgage or off of the car loan, but it is challenging.
Okay, yeah, that's an unfortunate aspect of that. And then let's talk about just bankruptcy. How long does bankruptcy stay on the record, and what's a good way to recover after you filed bankruptcy at a certain point in time?
So we help clients. Typically, bankruptcies will stay on one's record for about 7 years.
Okay.
What we have seen, though, and how we're able to help our clients is that ideally, in a bankruptcy, you get all the negative derogatory accounts under the umbrella of the bankruptcy itself. But what happens is when that bankruptcy is then put onto the credit report, some of those accounts are separated. So
Okay.
they're no longer shielded by the bankruptcy. Now, based off the Fair Credit Reporting Act, everything on a credit report has to be 100% accurate, complete, verifiable, nothing misleading, nothing obsolete. So once those accounts, they're called outliers, are no longer protected under the umbrella of the bankruptcy, it in fact is making that credit report inaccurate.
Okay.
So we can go in and get those negative accounts removed. However, the bankruptcy will stay on one's credit report for about 7 years.
Okay. And let's say somebody did file for bankruptcy today. What do they do to turn themselves around? They've got 7 years on record, but what can they do starting today to repair their credit and improve their chances of getting a loan for a home?
It's going to take time.
Okay.
So again, making those payments on time, making sure that your revolving credit cards are under 30%. Don't open any new revolving accounts because new credit ultimately will hurt the consumer's credit report the most in the first 30 days, and then a little bit less 60 days. But as long as if they don't have to open a credit card in a bankruptcy or out of a bankruptcy unless they need a secured credit card to build up their positive credit.
So basically just put everything on hold, assuming you can make your day-to-day, payments and whatnot, just kind of freeze your credit on your own and work on rebuilding your financial situation.
Correct.
What kind of debts reflect positively on your credit? I mean, what really helps boost your credit rating?
Well, the best mix of credit is, and it's any 3 of the 5 I'm going to mention: a mortgage, an auto loan, a revolving credit card, installment, or an open or other line of credit with no limit.
Okay.
So any 3 of those 5 that I just mentioned would be the best mix to boost a person's credit score.
Okay. And what's a good way to repair one's credit score if somebody's had some bad debts in the past? They didn't file bankruptcy, but they want to try and repair their credit score. What ways do they start working on today to get that repaired?
The biggest factor is late payments. So if there were late payments in the past, they can try to contact either the collection company or the creditor and ask to have any of those late payments removed, especially the newer late payments. Oftentimes, creditors will work with the consumer. And then also, I mentioned collections. Consumers don't realize that if they have an old collection on their credit report and they pay it, that's going to hurt their credit score. And the reason being is the credit score does not factor in a zero balance or a $1,000 balance on an old collection.
Okay.
What happens, the consumer will pay it, and it refreshes the date of last activity or the reporting date, and that will have the effect of lowering the person's credit score.
So it's a more recent report, basically, that on a debt.
Correct.
Okay.
So in cases like that, we like to educate and coach the consumer. In fact, is it their account or was it merged on, to their report from somebody else? So once we do our investigation process and it is our client's debt,
okay,
we work with them on the verbiage and how to pay that and then get it removed off the credit report. And a lot of collections, they're sold to these collection companies for pennies on the dollar. So if an individual has an old medical collection that's $1,000, it really, in theory, is only worth, maybe $100 or a couple $100. So we'll help the client negotiate a lower balance, pay that, get it deleted, a deletion letter, and then get it removed from the credit report.
Okay. So let's say a person is getting ready to apply for a mortgage, or they know they want to buy a house within the next couple of months, or within the next 6 to 12 months. what are the best ways to improve their credit, just prior to applying for the mortgage?
My recommendation would be to go to privacyguard or identityguard.com that I mentioned earlier, do the soft pull, look at their credit report, if they can in fact read it or find somebody reliable who is familiar with reading credit reports, see what type of accounts on there, both positive and negative, see what their mid-score is. They need to find out what score they need to be able to close on the loan and get the best rates possible. So in speaking with their realtor and other mortgage professionals, for me, when I was looking to purchase my house, I wanted to see what was on my credit report, and Privacy Guard did that for me.
Okay. You had mentioned, checking your credit, seeing if any errors, fixing any errors, and I know with mortgages, generally, the actual mortgage company likes to see that you have some savings, but savings itself really doesn't have any effect on your credit score, correct?
Correct, it does not.
So what are your thoughts on, using some of your savings to pay down your debts in order to improve your credit score? How effective is that?
So our recommendation, if the client is able to use some of their savings, we will assess all their credit card debt specifically.
Okay.
And all the credit cards are weighted evenly, and it's 30% of a person's credit score. So if an individual has 3 credit cards, they're all weighted at 10%. One has a balance of $100, the other card has a balance of $1,000, and the third card has a balance of, let's say, $5,000.
Okay.
We will find out what type of money the people have, and we'll coach them on what to pay off. So in that situation, it would be ideal to pay off the $100 credit card. If they have those 3 credit cards all maxed out to $100, $1,000, and $5,000, ideally you'd want to pay off the $100 credit card.
So savings is a good thing to have, and then using your savings to pay down your debt, that'll positively impact your credit.
Absolutely. So if a client does have money from their savings that they can apply to, let's say, their revolving accounts to get those paid down to that percentage, we would certainly recommend that.
Okay, so that's a good tip for people to know, and as they're getting ready to apply for a mortgage, or even in general too, if they just need to improve their credit, they're going to go buy a car or going to apply for another credit card, then those are good ideas to keep in mind.
And you brought up a good point. When going to purchase an auto, the best way to do that is go to your bank or credit union, get the loan up front, because what happens when the consumer goes to the dealership, they shoot the credit score out to all these different lenders. And it ultimately, all those inquiries, we have one client has 29 inquiries on his credit report.
Wow.
Inquiries are detrimental to a person's credit score the first 6 months, and it can lower a credit score 2 to 5 points in that first 6 months per inquiry.
Wow.
So
that's it's pretty heavy.
It is. And then 7 to 12 months, it's only hurting the person's credit score 1 to 2 points. And then the second year, it's not negatively impacting the credit score, but it will stay, those inquiries will stay on a person's credit score for 2 years.
Okay. That's great information. That's all the questions I have for you today. Did you have any final thoughts, or want to tell us a little more about your company?
Absolutely. So like I said, I'm the territory rep for all of Ohio. We have a Wednesday webinar, which is interactive. You actually see a couple of my coworkers on this webinar that goes over really in-depth information on credit and how it works. And consumers will come to us, not even being a client of ours, but just that they have specific questions that they would like to ask. And it's nice because people are embarrassed if they have low credit score. And so many consumers out there, whether it's a credit report reporting an error, or they're just trying to boost their credit score because some unfortunate things and events happened prior. So anybody's welcome to join us. It's Wednesday at 7 p.m. Eastern Time, and the dial-in code is 1-712-432-3092, and then the code that they'll be prompted to enter is 350517.
And is there any online aspect of this, or is it strictly via the phone?
Via phone.
Okay, and how does somebody get in touch with you if they need to call you or get in touch with your company? What's the best way to reach you?
So I depend on my inside team tremendously. We've got credit experts, and I'm traveling to Ohio a lot. So the best ways are 2 phone numbers. One is our 800 number that will go directly to my inside team.
Okay.
It's 888-795-9088. And then my direct phone number that goes to my office
Okay.
is 513-898-1680. So either way, depending on what the question is or how soon they need an answer, if it's something immediate, I would recommend calling that 800 number.
Okay, that's great. I know your company does almost nationwide in the United States. What states do you not work in, and how does somebody from another state get in touch with you? That same 800 number works fine?
That 800 number, absolutely. And even calling my direct number, every conversation is confidential.
Okay.
We don't sell any information, and we're licensed in all 50 states.
Yeah, if anybody needs any help or questions, or feel free to call you.
Absolutely.
Okay, great. Thank you.
Thank you.